Hey guys, JC Parets here, founder of AllStarCharts.com, and welcome to the JC Show, collabo with StockCharts TV. And what we like to do here once a month is really take a step back and talk about some of the most important trends, because markets trend. Contrary to popular belief, this is not, market prices and returns are not random. We know that. We have the data. We have the math. No less than a dozen MIT professors have written white papers on the subject that prices do trend. I'm making up that dozen, but I'd be surprised if there weren't at least a dozen from Wharton or MIT or whatever, smart schools. That's why technical analysis works, because what are we doing? We're looking for trends. We're recognizing trends. And I think an important trend, and let's just dive right into it, taking a look at the bear market that we've been in. There's no way that you could see here the Nasdaq 100 and the Russell 2000. A lot of people have different definitions for what is a bear market, what is a bull market. Sometimes you hear ridiculous things like, 20% higher is a bull market, 20% lower is a bear market. But that's literally just an arbitrary, random 20%. So that's silly. People who think that way, also 19.5% decline is not a bear market, but 20.1% is a bear market. Like, what kind of serial killer thinks like that? So that doesn't really help out a lot. I think the bigger way we want to look at bull and bear markets is, are the majority of stocks going higher? Right? That's what a bull market is. When the majority of stocks are going higher for a prolonged period of time. 6 months, 12 months, 18 months, right? 24 months. And those are more cyclical bull markets. Those can happen within bigger cycles. Like, throughout the 70s, 1960s and 70s, we're in a 15, 16-year bear market in the S&P 500. But we had huge cyclical bull markets within that. Just like in secular bull markets, you have cyclical declines, right? Like the early 90s, right? We were in a secular bull market in the stock market. Early 90s, you had a cyclical bear market. So cyclical meaning, 6 to 18 months, 24 months within a bigger picture framework. And I think that's what we have here. I think we're seeing a cyclical bear market. That's what it looks like to me. The market peaked in February of 2021. That was over 15 months ago. That's when the new highs list peaked. That's when the Nasdaq Advanced Decline line peaked. That's when the IPO index peaked. That's when all the ARK funds peaked. That is when biotechnology peaked. It's when Chinese internet peaked. A lot happened in February of 2021, and things have gotten progressively worse ever since then. So you'd be hard pressed to get me to say that this is a bull market. People are like, "Oh, JC, are we going to go into a bear market?" It's like, what do you call the last year and a quarter? We've been in a bear market, right? The majority of stocks have been going down, which is the opposite of the majority of stocks going up, which we would classify that as a bull market. So the question is not, are we going to enter into a bear market? The question is, how much longer are we going to be in this bear market? That's the bigger question. And I think it's funny that I'm using the word overwhelming, the overwhelming sort of message from the market is that prices of major indexes are below overhead supply. There's an overwhelming amount of selling pressure versus demand, buying pressure. And that's what puts pressure on these stocks. So here we're looking at the anchored VWAP off the COVID lows for both the Nasdaq 100 and the Russell 2000. We're below that. So in other words, the average buyer since the COVID lows is down. Think about that. That was the best 52-week period in stock market history off the COVID lows. Best ever. Best year ever. The average buyer from those lows before the best year ever took place is now down, giving up all of the gains from the best year ever. How about that? The S&P 500 has kissed it, right? So remember, this is an anchored VWAP to the COVID lows. So understand that this isn't like a random moving average with no market history. Moving averages do not serve as support and resistance. There's no history there. It's just an invisible line. It's an average of all of the prices. There's nothing real that happened at those prices. However, the anchored VWAP, or VWAP in general, is the volume weighted average price. So yes, there is market memory there. institutions are actually using that to make decisions. So there really is support and resistance at those levels. And the S&P 500 so far has held that. As we record this on Wednesday morning, the S&P 500 is still holding it, still above that. But you'll notice that the Nasdaq and the Russell 2000 have not. So the question is, who's right? Is it the S&P is right, holding above that anchored VWAP, or is it the Nasdaq and the Russell 2000 are right? They're the leaders. They peaked before the S&P, and now the S&P is going to break also. Or is the S&P the leader, and then these guys are going to get back above their anchored VWAP? Which is it? There's probably more evidence that suggests that the S&P will ultimately break its versus these getting back above, but we'll let the market decide, what the story is there and give us the heads up. This probably is the most important chart. Maybe the dollar and 10-year yields, which we'll get to in a minute, are probably equally as important. But this tells the story, folks. When I say that the stock market is below overhead supply, this is what that is. These are the 2018 highs. This is the All Country World Index ex-US, and this is developed markets outside of North America. So think a lot of Europe and Japan down here. And this is the rest of the world outside the United States. And I was taught that we want to be buying smiley faces and selling the frowny faces. But what do we have here? Frowny faces, right? We are below the 2018 highs. If you guys see me give a presentation at any point in the last year, I have probably brought up this chart and said, hey, if we're not above those 2018 highs, it's a problem, folks. It's a big, big problem. And guess what? It's a big, big problem. We are below overhead supply. There are dead bodies above head that are literally sitting there to sell to you upon prices getting to those levels. That's what we call overhead supply. So until these markets can get back above the 2018 highs, they are guilty until proven innocent. Shout out Brian Shannon. That's something he would say. Guilty until proven innocent is the stock market globally. Now, we talked about how the average buyer off the COVID lows is now down. Just insane to think about, considering we had the greatest 52-week period ever within that. This is the median stock, right? The median stock in the United States, this is the value line geometric index. It's a great way to tell. So, we talk about large caps, we talk about small caps, we look at the S&P 500 and the Dow, and there's all these indexes. But what about the median stock? The median. The median stock is also below its 2018 highs. Just like the ACWX, just like the EFA, right? ACWX, All Country World Index ex-US. EFA, developed markets outside North America. Very important global indexes, both below the 2018 highs. The median stock in the United States, below the 2018 highs. And I got people asking me if we're going to go into a bear market. What do you call this? What is this? Is this a bull market by your definition? Because the S&P 500 is not down 20%, so we're still in a bull market? Like, you got to be like a serious freak of nature to think that makes any sense whatsoever. Are the majority of stocks have the majority of stocks been going up for a while, or have the majority of stocks been going down for a while? And it's quite obvious that it's the latter. These are big frowny faces, guys. These are big, big tops, right? So here we're looking in the middle. We're looking at the Russell 2000 small cap index, broke all that support. And then it was led by the small cap growth areas, right? Broke all that support. And then it's the value areas that have held up the best. And even the value areas, IWN, so this is small cap value, has broken down as well. So we need I don't say we need. The market, I believe, needs small caps to recover here. And if the leadership group is small cap value, that's likely to be the first one. Right? So that's what we're watching. So call it, realistically 155, 155. We start getting above 155 on the IWN, as in Nancy, the small cap value. That will be very impressive for me. That's step one. And if that's happening, these are likely rallying too, but you're not going to get back above those support levels before this one. This is likely to be the first one. So that's what I'm watching there. And I think a lot of it has to do with this. I got two charts for you. This is what I like to refer to as like the best backcourt in the market, right? The best backcourt duo. is the US dollar and US Treasury bonds. So first of all, here's the US dollar getting back to those former levels, right? These are the 2016 highs, right? So if you recall, as soon as the dollar index peaked, that is when stocks started doing well. When the dollar index peaked, stocks did very well during this period. If you recall, 2017 was like one of the greatest years of all time. I don't think there was like a single day where the market was down 1%, like the whole year. It was something ridiculous. I remember like on Twitter, people were like putting the count. It's been so many days since the S&P fell 1%. It was like absurd. And all of that happened as the dollar index declined. So then what happened? Dollar index bottomed in early 2018. And what happened? Stocks peaked in early 2018. Stocks peaked in early 2018 when the dollar index bottomed. Stocks started rallying when the dollar index peaked at the end of 2016. Stocks peaked when the dollar index bottomed in 2018. So then what happened? Stocks struggled after that while the dollar was strong. And then what happened? Stocks bottomed in March of 2020. And as stocks bottomed in March of 2020, what was the dollar doing? It was peaking. Coincidence? I'm thinking no. So, okay, great. So then what happened when stocks bottomed after March of 2020 and the dollar peaked? Well, the dollar got smoked. And what happened over the next year? The dollar got smoked and the stock market had its greatest 52-week period ever. And then what happened? And then in 2021, stock market peaked, right? Most stocks started going down instead of going up. That's been going on for 15 months now. And during those 15 months, how's the US dollar done? Straight up as stocks have been under pressure. So, the question I pose to you is, do we think that the US dollar matters? Do we think the US dollar matters? I think it does. I think if you don't think the dollar matters, I think maybe you're not good at math, maybe? Or maybe not even that. Maybe it's you think the correlations are going to change now all of a sudden, which is certainly possible. I'm going to bet that correlations are not changing. That's a bet I'm going to make. The bet I'm making right now. And then if correlations do change, then we'll see it in the data. But the bet I'm making is that correlations are not going to change. So, if the dollar index breaks out of this monster base, starts taking out these highs, how's the stock market probably doing in that environment? Probably no bueno, right? No bueno. If the dollar starts falling apart and runs into that resistance, that's real resistance, and the dollar starts getting under pressure, how are stocks going to do? I don't think it's bad for the stock market. I think it's good for the stock market. Then, of course, you have the euro. Represents almost 60% of the entire dollar index down to key support. So if the dollar index breaks out, you're looking at a euro collapse down to the 2000 lows, right? You're seeing a euro collapse if the dollar is going to break out. That's what you're seeing here. The completion of this continuation pattern from this long-term downtrend, right? Now, if euro can hang on there, I mean, it's hanging on there for dear life, but if it can hang on there, I think it's good for stocks. And then, of course, the bond market. Worst start to a year for the bond market ever? Is that I hate to be like all dramatic and everything, like best 52-week period ever, bond market, worst start to a year ever. I think it is. I think, obviously, I think it depends on how you define the bond market. Worst start to a year for the bond market ever, maybe? It's pretty bad. And then what happens with the decline in the bond market? Well, $119 trillion? What it was, probably less than that now. I probably shouldn't laugh at that. But it's just hilarious just how massive a market the bond market is. All right, $119 trillion and falling. Great. When there's a heart attack in the bond market and you're getting volatility in a $120 trillion asset, plus leverage, of course, because the bond market, you need leverage. It's going to trickle into other asset classes. You know, these institutions that have all this exposure to the bond market and all these, you know, sophisticated, messy ways, sophisticated. You have to be really smart. Maybe, or maybe they just use too much leverage. I think it's probably both. The bond market crashing and interest rates spiking have been the primary reason why these growth stocks are getting slaughtered. Like, I'm not a fundamental guy, you know that, but you can find them. Like, and you go ask like a CFA. You know, take the CFA out of the spreadsheet for 2 seconds and buy them a beer, or take them for some coffee or something, or a CPA, one of these accounting people, and then have them show you why the multiples get crushed in growth stocks as interest rates are going up. Because you can see the earnings. Remember, these are long duration growth stocks, so they're going up in price now based on what they're going to earn in like 10 years or something like that. But when you see the interest rates going up, you could see those earnings, like, you know, really get slaughtered. I mean, so have them show you that math so you could really understand why the bond market getting crushed and interest rates spiking really hurts those growth names a lot. And as it turns out, the United States has a lot of growth exposure, which is why it's done so well over the last 10 years and why it's doing so terrible over the last 15 months as bonds. Remember, the stock market peaked in February of 2021. And what have bonds been doing since February of 2021? What have they been doing, those silly bonds? Have they been going up or have they been going down? Treasury bonds since February of 2021. They've been going straight down. Straight down. So I think, and then people are like, well, JC, aren't bonds supposed to go up when stocks, are going down, right? Don't they have an inverse correlation? They do when deflation is the problem, right? Or the worry. I shouldn't say problem, but the worry. When deflation is the problem, as it was for the last 20 years. The worry was deflation. When the worry is inflation, like in the 60s and 70s, for example, you have a more positive correlation. So they're moving together. So the 60-40 portfolio that, a lot of programs and financial advisors and just algorithms were programmed to do, the risk parity trade, blowing up this year. Blowing up. 60-40. 60-40 zero is what it should be called. 60-40 zero. 60% stocks, 40% bonds, or 60% bonds, 40% stocks, and zero commodities, which is the third asset class, which people forgot because commodities had been in a bear market for so long, people forgot that it was an asset class. As it turns out, it is. As it turns out, when crude oil was trading below zero, that was not sustainable. Imagine that. Imagine that crude oil below zero is not sustainable. We were eventually going to have to pay for oil, as it turns out. Can you imagine that? Not only are we going to have to pay, were we going to have to pay more after it went below zero in 2020, but we're back to the highs from the last 10 years. Back to the highs. So we keep pushing up against these highs. That's where the strength has been in energy. And there we are, XLE. So where are we today on the XLE? At 83 almost. So we're above these former highs. As long as we're above 79 in the XLE, I think we need to be bullish energy stocks. Here's what I will say, though. The outperformance out of energy has just been on a whole nother level. Best performing sector of 2021, energy. Best performing sector of the first quarter this year, energy. Best performing sector of Q2 so far, energy. Best performing sector in May, energy. That's where the relative strength is. But what I will say is something interesting. With new highs in the XLE yesterday, we're seeing lower highs in the XOP and lower highs in the OIH. The XOP is the explorers and producers specifically, right? So XLE are the integrateds, a lot of Chevron, a lot of Exxon, super mega caps. XOP are the explorers and the producers. So it's a great ETF. If you're interested in investing in the in those types of names, explorers and producers, if that's what you're into, go for it. But from an informational standpoint, I really like it a lot too. Same thing with OIH. OIH, we're looking at the oil services. So take a look at both of those. Neither one of them are making higher highs. In fact, they've been making lower highs for almost a month. XOP and OIH. So I think we need to look to that as a divergence. And if XLE is below 79, all bets are off. All energy bets, in my opinion, have to be off if XLE is below 79. The divergences are there. XOP and OIH already been rolling over for a month. Oil hangs in there, which is also strong. But with energy is the last one, right? Because the theory is that this is 2008 all over again, when the stock market, the S&P peaked in October of 07, and then energy and some of the fertilizer stocks continued to rally into the summer of that year, 2008. So for another 8 months or so, I remember it well. So is this what's going to happen again, where it's energy and a few other names that are surviving, that are holding up the best, and they ultimately fall apart, right? That's what seems to be the consensus. That's what everybody seems to be pointing to. By the way, if you're interested in these slides, go ahead and email info@allstarcharts.com. Make sure to use the password bear market. So if you're interested in the slides, info@allstarcharts.com, password bear market. So we have a few more minutes, and I think it's important to show, sort of reiterate this overhead supply that we're seeing in a lot of these markets. These are some of the most important stocks in the world. One might argue these are the most important stocks in the world. Apple, Microsoft, Google, Amazon. Do these look like smiley faces or frowny faces? You know, what was I taught? Was I taught to buy the frowny faces, or was I taught to sell the frowny faces? The problem that we have here is that we're below overhead supply in all these names. So any strength we see is going to run into that former support. And what do we know from our polarity principles? Is that former support turns into resistance, don't it? So the market, just like we were talking about some of these other levels in the Russell 2000, the small caps, remember the geometric value line index above the 2018 highs, the ACWI All Country World Index and EFA back above the 2018 highs. In these big names, we got to get back above that former support from last year. Back above that support in Amazon, Microsoft, Apple, Google. And we're not. We're below. So the market's got a lot of work to do, folks. I think the market's got a lot of work to do. This is something interesting that I think is worth pointing out. This is a large cap healthcare. Large cap healthcare on an equally weighted basis, right? You can see the names, you're familiar, right? Pfizer, Johnson & Johnson, UNH, right? Eli Lilly. Doing well as the market has been doing poorly. Doing well as the market's been doing poorly, showing that defensive nature to it. Look at these things. Big basis. Big basis. Now, like some of these other indexes that I've shown you, we got to be above these former highs. These are 20-year bases, folks. 20-year bases. Merck, Pfizer, Bristol Myers. So we've seen some shakeouts. We're likely to see more shakeouts. A resolution out of a 20-year base probably isn't going to be something clean and simple. It's probably going to be messy and dirty and frustrating. But that doesn't change the fact that we are seeing 20-year bases in Bristol Myers, in Pfizer, in Merck. Do we get those breakouts? Do we get them? Do we get breakouts that hold? More importantly, most importantly, do we get breakouts that hold? So we'll be talking all about that in our conference call, our monthly conference call on Thursday. If you're a premium member of All Star Charts, I will see you there. If you are not a premium member of All Star Charts, email us, info@allstarcharts.com. Use the password bear market. I'll send you the slides, but ask Peter to hook you up so you can get into the monthly conference call. Tell him JC said that if I asked for Peter and told me to hook you up, he said to hook me up. Tell Peter that JC sent you. So info@allstarcharts.com, password bear market if you're interested in the slides. And if you want to join us on the live conference call Thursday night, tell Peter JC said so. Thanks, guys. Adios.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.